Options involve risk and are not suitable for all investors. Options investors may lose the entire amount of their investment in a relatively short period of time.
Today we're going to talk about option trading, specifically the basics of covered call writing. Covered call writing is a very good beginning option strategy. Now, before we get too far along though, let's define what an actual option is. An option in general is a contract, and it gives the owner the right to buy or sell an asset at a fixed price for a specific period of time. It then obligates the seller of the contract to take the opposite side if and when the right embedded in the option contract is exercised by the owner. Bottom line is, the buyers of contracts, they pay cash, and for that cash they get a right. The seller of the contract receives the cash, and for receiving that cash, they take on an obligation. So in covered call writing, we're going to be selling a call option, which means that the buyer can call stock away from us if they would like. So let's look at an example here. We have 100 shares of XYZ in our example. That stock is trading at $60 a share. If we were going to buy that 100 shares, it would be $6,000 plus commission to do that. Now, on top of it, when we buy those shares, we're going to sell a XYZ fake stock call option. The strike price on our call option is $62.50. That means the buyer can call stock away if the stock is above $62.50 at that strike price of $62.50. Now, for saying we'll sell our stock at that price, we bring in $2, which can be used to actually buy the underlying stock. So instead of paying $60 for the stock, a lot of people like to think of it as our cost basis on the stock is $58 or $5,800 plus commission. Let's fast forward to expiration. Let's talk about what can happen, the nuances of covered call writing throughout the life of the option contract. So at expiration, let's say we are correct on our forecast and the underlying stock goes up and it goes beyond $62.50 by expiration. What type of profit would I have in my account for this position? If XYZ is above $62.50, our cost basis is really $58. So we have a gain of $4.50 or $450 on this position. If we look at that on a percentage basis, that's 7.7% over a 57-day period. Not too shabby if you think about, well, we were correct on our forecast and we were able to bring in that premium to help out on our max profit on the upside. If the stock goes nowhere, XYZ just stays right at 60. Let's just pretend it didn't move at all. 57 days go by, the option expires. Well, our cost basis now is $58. That means that we received the $2 for selling the option contract and we lowered our cost basis. That means we've lowered our cost basis by 3%. Now, if the stock goes down, we still have risk, right? We still own that stock. So on the downside, anywhere below 58, losses will occur. But then again, if we just own the stock, our losses would occur from 60 on down. So this $2 worth of premium gives us a small pill to land on when we're looking at our stock position. It gives us just a little bit of a buffer. So now if we look at the profit and loss graph for this position, we kind of show this. If we just bought stock outright on the x-axis, right where we paid for the stock, if we just bought 100 shares, our cost basis would be $60. Now, if we do the covered call, we move down on the x-axis to 58, the premium that is received. There's always going to be a give and take with options. So we're lowering our cost basis, but then you'll notice when we get up to 62.50, the line flattens out. That means that we're giving up some opportunity on the upside. We lower our cost basis now, and the biggest risk as far as the option is concerned is to the upside in that opportunity cost. But overall, this position, we're saying, well, if the market goes up, I'm willing to sell it. I might as well get paid now for saying I am willing to sell later. Things to think about. These are the important notes that you want to know if you're dipping your toe into covered call writing. First of all, how do I enter into this trade? Can it all be done as one trade? Most brokers do have a trading screen that is called covered call writing, or the ability to buy the stock and sell the call in all one transaction. So you can do that if you choose. Which position causes the risk when we're looking at a covered call position? The stock or the option? Well, in this instance, it's the stock, right? I own 100 shares of stock, so I have a lot of downside from just owning stock. The option only causes an opportunity risk. On the upside, in our example, if the stock was above 62.50, we could not profit any more on the stock because the option was saying we're willing to give up our shares at that strike price. I get paid now for saying I'm willing to sell higher later. Am I stuck in this position until expiration? The answer is no, I am not. I can always close out my option contract and sell my stock. When may I be assigned? In other words, if I sell a call option, I take on an obligation, but I am not in control of that obligation, right? The person that has bought that option contract is the person that is control. If the option contract gets in the money, might I be assigned right away? The answer is usually no. You're usually going to be assigned a little bit closer to expiration. And in order to understand that, you have to think about the person that has bought this option contract. What is the benefit to them of exercising their call option early as opposed to later? They know what price they're buying the stock at, so why exercise now and spend cash now buying the stock and having all the risk of owning that stock when I can exercise later? So keep in mind that if I do covered call writing, normally when the stock gets in the money, even though you might want them to assign it and sell it at that price, it's usually going to happen closer to the expiration date. Next one, can I buy the stock first and then sell the call later? And the answer here is definitely yes. And this is mostly the way people do it. I've had a stock position on, I've made some profit on it, the market's starting to go up. I wouldn't mind if it went up a little bit higher that I'm going to get out of the trade. So yes, I can definitely buy the stock first, hold it for as long as I like, and sell a call later. And honestly, that's usually how most people will do it. Do you really want to sell the shares? Now, this is kind of a tricky question. I've had a lot of beginning option traders say, oh, I went out and I sold this call option against my stock and the stock started going up and I lost all this money. I'm like, well, wasn't the call above where your stock was at? Well, yeah, but the stock just kept going. Here's my advice. If you sell a covered call, the stock goes above your strike, stop getting quotes on it. Right? The stock's gone. Forget about it. Move on to your next position, let it get called away, and then once you get the capital, you can go out and do another trade. Too much premium. Is there too much juice in the option contract? And the answer is that is possible. If you look at something and it's usually too good to be true, this means you need to research the stock. So you want to go on out and you want to look, is there any major news events that are going on? When are earnings going to be announced? Usually, if the premium seems too high to you after trading calls, it's usually because there is an unknown risk. The options marketplace knows all, and you really should do some research. And then another thing is it possible to not get enough premium? I've looked at some stocks, some low-flying stocks that don't move a ton, and I just look at a covered call and I'm just like, you know what? A dime or a quarter or a nickel for 20, 30 days out, it's just not enough, and I just choose not to do the covered call position. Well, that's it for today. I look forward to your questions and comments. In the meantime, may all the options you bought finish in the money and all the ones you sold finish out.